Trump's shocking push to tame the Federal Reserve could reach straight into your pocket and squeeze every dollar you own. Imagine a nationwide tug of war. On one side stands the White House. On the other, the bankers sworn to defend the value of the US dollar. Stretched in the middle is your savings, your rent, your grocery budget. Hear that rope creak? That's your paycheck begging for mercy. Skip the abs class. Politics is giving you a core workout for free. I'm Alex, a former Wall Street reporter who translated Fed speak for a living, and in the next 8 minutes, I'll decode how this brawl may hike your mortgage, gut your retirement, or if we're lucky, land you a temporary break on your credit card bill. By the end, you'll know the real score behind today's headlines, and you'll be better armed than 90% of the internet hot takes. Ready? Let's yank that rope. Quick recap before the punches land. The Federal Reserve is America's financial doctor. Its job for the last 111 years has been to keep prices steady and people employed, like checking your temperature while making sure you still have snacks. To do that, it sets the base interest rate that ripples through every loan, savings account, and stock price. Independence is its secret sauce. Decisions based on data, not campaign slogans. Enter President Donald Trump 2.0. Since winning a second term, he has hammered Fed Chair Jerome Powell for keeping rates too high, calling on him to resign immediately. Trump even told reporters he has 2 or 3 replacements in his back pocket. One of his allies, Governor Michelle Bowman, was just promoted to vice chair for supervision, giving the administration an internal megaphone. At the same time, an executive order now requires independent agencies to route major regulatory moves through the Oval Office first. It's like telling the doctor to phone your boss before prescribing antibiotics. Why should you care? Picture this. You wake up tomorrow and the world's traders no longer trust the dollar's guardians. Foreign money flees, the dollar sinks, and suddenly imported coffee costs as much as a small pizza. The bond sell-off alone can raise 30-year mortgage rates even if the Fed cuts its own short-term rate. You win a penny, but drop a dollar. Let's break the drama into 3 acts. Act 1, the legal limbo. Can a president fire the Fed chair? The Federal Reserve Act says a governor may be removed for cause, usually meaning corruption or neglect, not "I don't like your spreadsheet." In May, the Supreme Court tightened that definition, so a firing would trigger a courtroom thriller. Markets hate thrillers. They prefer snoozy documentaries. During the 48 hours after Trump floated replacing Powell in June, the Dow shed 600 points, and Treasury yields spiked by 0.1%. Expensive excitement. Act 2, the shadow cabinet. If direct firing flops, the White House can still reshape policy by stacking the Board of Governors. 5 of 7 seats could be filled by 2027. Bowman at supervision is just the start. Names like former Governor Kevin Warsh, known for hawkish rate views, or current Treasury Secretary Scott Bessent, a free money fan, are whispered in DC bars. The mere rumor softens Powell's authority. Imagine your boss announcing she'll retire next year while a replacement shadows every meeting. How decisive would you feel? Act 3, the rate roulette. Suppose the Fed caves and slices its policy rate by a full percentage point next quarter. Variable rate credit cards drop, auto dealers plaster 0% signs everywhere, and we cheer. 6 months later, import tariffs on steel, microchips, and sneakers kick in. Factory owners pass those costs to stores. Stores pass them to you. Inflation pops above the Fed's comfy 2% zone. Investors recoil, lenders demand risk premiums, and fixed mortgage rates leap 2 points. Your early celebration turns into a 30-year hangover. Midpoint twist. Cheaper money today can secretly inflate tomorrow's taxes. When the Fed pins rates too low for too long, Uncle Sam's borrowing binge looks painless. But debt doesn't vanish. Interest payments swell once markets enforce higher yields. Future Congresses face a brutal choice: slash services or raise taxes. The rope snaps, and whichever side you're on, the fall hurts. Speaking of pain, remember when pineapple on pizza sparked outrage online? Picture that flame war, but with trillions of dollars in world capital flows. Nobody rage quits the economy, they just take their money somewhere else. Let's walk through your personal money map. First stop, mortgages. If you hold an adjustable rate mortgage, watch the 2-year Treasury yield. Politically pressured cuts may dip your monthly payment in the short run, but if inflation expectations climb, refinancing into a fixed loan later could cost thousands more per year. So consider locking in a rate while spreads are still narrow. Second stop, credit cards. Most cards peg rates to the prime rate, which follows the Fed. A forced cut gives instant relief, but card issuers often widen spreads when volatility rises. Translation: they keep the discount and leave you with a smaller slice. Pay down variable debt while you still have the gift. Third stop, savings. Banks slash savings yields quickly when the Fed cuts, but raise them slowly on the rebound. If you rely rely on interest for income, hunt for online banks or short-term treasury bills before yields fade, and keep an eye on the inflation-protected I-bond rate. It resets every 6 months. Independence drama can make the next reset less generous. Fourth stop, retirement accounts. Stocks might surge on cheaper money, but sectors react differently. Big tech loves low rates. Regional banks fear margin squeezes. Commodity funds hedge inflation, but whipsaw on tariffs. Diversify now rather than in panic later. Rebalance every quarter during political fireworks. Fifth stop, everyday expenses. Inflation hits poor households hardest. Food, rent, gas. If tariffs and easy money collide, price tags climb even faster than wages. Budget a cushion. Bulk buy essentials before you see headlines about price controls or windfall taxes. Now, some ask, isn't the Fed already too powerful and out of touch? Fair point. More transparency could help. But stripping independence is like fixing a wobbly wheel by removing the brake cables. You might roll faster until the first downhill curve. Take Brazil in the early 1990s. The central bank printed cash to fund government programs. Inflation sprinted past 2,000%. Savings evaporated, and economic misery followed until an independent mandate was restored. History shouts, politicized money melts. Pattern interrupt. Grab your phone, open your banking app, and imagine the balance slashed by 20% overnight because the dollar cratered. That bleak number is not sci-fi. Emerging market families live it. Rule of thumb, if a politician brags about cheap money, translate it as future inflation you'll pay for. Real-world snapshot. When Trump first floated negative interest rates back in his earlier term, the 10-year Treasury briefly dipped below 1%, then rebounded to 3% within 18 months. Whiplash for anyone refinancing a home. In 2025, similar jawboning pushed 30-year fixed mortgages from 5.2 to 5.7% in just 2 weeks, adding roughly $100 a month on a $300,000 loan. That's a used car payment materializing out of thin air. Small business check. Meet Tony, a cafe owner in Austin who emailed us last month. She locked in a low-rate line of credit during the pandemic. If short-term rates plunge, her payments shrink. Great. But if lenders fear inflation, her next restock of imported coffee beans spikes. Low rate, higher cost, profit crushed from both sides. Tony needs stable policy more than cheap money. Investor angle. Pension funds manage trillions for teachers and firefighters. Their models assume a steady relationship between inflation and bond yields. Political meddling smashes those assumptions, forcing funds into riskier assets to meet return targets. That risk eventually lands on taxpayers to fill any shortfall. Your county's future tax hike could be the hidden price for today's headline feud. Global Mirror. Turkey in 2021 fired 3 central bank governors in 2 years. Inflation soared past 80% and the lira collapsed. The lesson is stark. Credibility lost is hard to win back. The United States holds the world's reserve currency status precisely because it avoided that trap so far. Credibility brings perks. It lets Washington borrow at lower rates, which funds highways, social security checks, and even defense without crushing taxes. Undermine the Fed, and the national credit card APR jumps. Every extra percentage point on $20 trillion plus debt costs over $200 billion annually, enough to fund the entire Department of Education. Still think Fed independence is dull? When you swipe your card at a grocery store, invisible traders in London and Tokyo are valuing that dollar in real time. They watch the Fed for clues. If politics muddies those clues, they raise the price of swapping yen or euros for dollars. Your imported cheese just got a tariff-free price hike. Hope break. There is a guardrail. Congress can reinforce the Fed by passing a clear, bipartisan commitment to central bank independence. Some lawmakers are already drafting an amendment to tighten the firing language around "for cause." If voters care, that bill moves faster. So talk to your representatives. The rope is in all our hands. Okay, you know the risk map. Now, action items. 1. Build a 6-month emergency fund in mixed assets. Cash for bills, treasury bills for safety. 2. If you own a home, get a free refinance quote weekly until rates settle. Lock when terms look fair. 3. List every debt with a variable rate. Pay the smallest first to free cash flow, then attack the highest rate. 4. Shift new contributions in your 401k toward inflation-protected bonds or dividend aristocrats. Keep your mix age-appropriate, but lean defensive. 5. Stay informed by following official Fed statements, not meme accounts. The difference between patience and persistent in Fed speak can move markets. Knowledge is compound interest, growing every day. You're still here, so your financial IQ already beats average. Share this video with one friend who still thinks the Fed prints money in a basement. So, what's the bottom line? Trump's team is is leaning hard on the central bank, and the showdown could rewrite your personal balance sheet. If the Fed bends, you may see quick relief at the checkout, but like a sugar rush, the crash lasts longer than the buzz. Guard your future self, diversify, watch rates, and vote for leaders who respect sound money. Now, I want to hear you. Is Trump right to bully the Fed back in line, or is independence worth the wait for lower prices? Drop your take in the comments, tap subscribe so you never miss the money moves that matter, and smash the bell so YouTube pings you before markets panic. Ready for the next AI Paycheck hack? Tap the playlist that just popped up.